So if you have ever owned stock in your life, maybe through a retirement fund or even just individually, then you've owned part of a C corporation, most likely a C corporation. So there are two types of basis with regard to corporations. So that, well, let me back up a little bit. So that stock, if you had ever purchased any, would have a basis. However much you paid for it is your basis in that stock. But there are two types of basis, just like with partnerships, there's inside basis and there's outside basis. So inside basis, again, would be the basis to the corporation of its assets, right? Outside basis is the owner's basis in their investment in the corporation. So that's mostly what we're talking about here with regard to corporations, is that outside basis. So when either a C or an S corporation is formed, individuals will purchase stock. Either one of these, there's stock involved. It's an exchange of cash or property for stock. It can be a taxable transaction. So remember when we talked about partnership formation, there were very few instances where tax might be owed on the formation of a partnership, because for the most part it was just transferring it. You're just taking it from one account, putting it into the partnership, which is kind of like another account, just transferring that between. It's a little bit different with corporations. So if the transferors, so the shareholders who are forming, control 80% or more of the corporation after the exchange, generally speaking, the exchange is tax-free. So if whoever is forming it, if they control 80% or more together of the corporation, then that exchange is generally tax-free. So here's an example. Marty and Sarah are forming Boone Company. Marty transfers $100 in cash in exchange for 100 shares of stock. So his base is going to be $10 per share of stock. Sarah is transferring a bond with a fair market value of $1,000. Her basis in that bond is $800. She's also getting 100 shares in exchange for that. They're the only two shareholders. Because they control 80% or more immediately after exchange, the transaction is tax-free. They're each 50% owners. They're cool. It's over, they're over 80%. But there are times when a stockholder, even if that 80% rule is met, that the stockholder could be required to recognize a gain. So the first time, when the individual, the shareholder, transfers property that is subject to a liability. So now we're talking about some type of, like, for example, a building, but there's a mortgage attached to it, right? So a $100,000 building, but it has a $50,000 mortgage attached to it. If the relief of the liability is greater than the transfer's basis in the property. So my $100,000 building, but I have $120,000, my basis is $100,000, but I have a $120,000 loan on it. So, and I transfer that over to the corporation's going to be taking on that loan as well. Now I do have a gain in the amount of $20,000 because I was relieved of $120,000. It's just like I got $120,000 richer, but I gave up $100,000, right? So the gain is equal to the excess of the liability over the basis. So again, if we've got that building, has a basis, I don't know what the fair market value is. Maybe the fair market value is $1 million, right? That happens, you know, property goes up in value and then people take loans against the increased value of that property. But my basis is $100,000, but I have a mortgage of $120,000. So the excess of that, this is my gain, okay? Because I got a $120,000 benefit with the release of that, but I received in exchange for those shares. So my benefit is $120,000, but what I gave is $100,000. So my benefit was $20,000 more than what I gave up, okay? So in that case, I have a $20,000 gain. Another example here, Gina. She's transferring an apartment building in exchange for all of the stock in a company. Building has a basis, $100,000, fair market value of $500,000, and debt of $300,000. So obviously at some point she took out an additional loan on the building in order to get some cash out of it because it had increased in value. So she controls more than 80% of the company. However, it's still going to be taxable because of that debt relief in excess of basis. So her gain is going to be $200,000, which is the $300,000 of debt relief minus the basis of the property. So she's going to have a gain that she's going to have to recognize of $200,000. So that's the first case where there might be a gain. Second case is when an individual contributes cash or property and receives in return stock plus something else. So you're not getting just stock, you're getting something else. Maybe it's cash, maybe it's a piece of property, something like that. So you're not just getting stock. This is called boot. Okay, so this terminology, whenever you get something in addition to the shares, then it's considered boot. So in this case, the taxable gain is going to be the lower of either the fair market value of the property received or the realized gain, which is the fair market value of the property contributed less the basis of the property, fair market value of the property contributed less the basis of the property contributed. So whichever is lower of those two. So let's look at an example here that they've got. So we got Ernie. He has formed EBU company and he got all the stock. So he contributed a machine with a basis of $15,000, fair market value of $25,000. He also got $3,000 in this exchange from the company. So the gain on the transfer is going to be $10,000, which is the difference between the fair market value and the machine. Or actually, it shouldn't be the gain on the transfer. The gain on the transfer is $10,000. The gain on the cash received though is $3,000. So you compare those two things. So he's got fair market value of the property received, which was $3,000. He received $3,000 in cash. That's the fair market value of that. Or the realized gain, which is the fair market value less the value of the property contributed, as though he sold it, right? So what that gain would be if he had sold it. So in this case, like if he had sold, and you can kind of think of it in those terms. Think of it, if he had sold this property for $25,000, he's got a basis of $15,000, his gain would be $10,000, right? We're going to compare that to the value of whatever it was that he received, which was $3,000, and whichever is less of those two, whichever is lower, is what the gain that he has to recognize. Okay, so you kind of, like I said, pretend it was sold. What would the gain be? So that's your first calculation, and then whatever the fair market value of what was received, compare those two, and you're going to take the lower of that is going to be the gain that has to be recognized on the property. So just like with partnerships, the basis of the cash or property received is equal to the basis in the hands of the shareholder plus any gain recognized by the shareholder. So in Ernie's case, so he's received, the basis of this property was $15,000, but he's going to have to recognize a $3,000 gain. That means that for the corporation, their basis in the property is $18,000. Those two added together. If there was no boot and he didn't have to recognize a gain, then the basis to the company would just be the $15,000. It's just going to transfer over. But because Ernie had to recognize some gain, now that gain gets attached to to the property that was actually contributed. The basis of the stock, so what would Ernie's stock be worth? Basis of the stock in the hands of the shareholder is equal to the basis of the property contributed plus any gain recognized minus any boot received. So in Ernie's case, the basis in his stock is going to be the $15,000. So what is this example? Oh, Ernie. Yes. So these are the previous examples. So here's Ernie. He reports a $3,000 gain. His stock basis is $15,000, and this is calculated by taking the $15,000 basis of the property he contributed, adding the gain that he had to recognize, but then subtracting the property that he received, whatever he received. So this is just in and out. So 15,000 plus 3,000 minus 3,000. So 15,000 is his basis. The property to the corporation, the basis to the corporation is 18,000, which again is going to be the $15,000 that transferred over plus the $3,000 that he had to the gain that he had to recognize. Okay. Let's see, Marty and Sarah. I can't remember their example. Oh, they were. Are they here? Oh yeah. So $1,000 cash. So Marty, that's easy. $1,000. His basis in the stock is $1,000. Right? Sarah, her basis in the stock, that basis transfers over, but she didn't receive anything in exchange. So her basis in the stock is $800. Okay, and the basis to the corporation is the same as well. Let's see, Gina. So Gina had to, let's see if we can figure this out. So basis of 100,000 was transferred to Gina, but she had to recognize a $200,000 gain. So to the corporation, the basis in the building is 300,000, I think. Yep, 300,000. She has to recognize a gain. Basis to the shareholder, property contributed plus any gain recognized minus any boot received. So basis of the profit, again, 100,000 plus the gain of 200,000 minus the boot that she received, which is essentially the debt relief of, let's see, so that's 300,000. How did they, let's see. Did they say anything about that? It says it's 0. Let me think this through. Basis of the stock in the hands of the shareholder equal to the basis of the property contributed. So she contributed 100,000 plus she received a $200,000 gain. Oh, okay, that's right. Plus she had to recognize a $200,000 gain, so we're up to 300,000 minus any boot received, which was the release of the liability, the 300,000 that she received. So 100,000 plus 200,000, 300,000 minus 300,000. So that's why her basis in the stock is now 0. So Gina contributed, let's see. So basis of 100,000 in the building, and then she had plus the gain that she had to recognize minus the boot received, which in her case was the release of the liability. So that's how we get to 0 for her basis in the stock. There is no loss that's recognized as a result of the formation of a corporation when the 80% test is met. If an individual provides services in exchange for stock, then the individual still has to recognize ordinary income equal to the fair market value of the services. So if I contribute $1,000 worth of services in exchange for 100 shares of stock, now I've got to pay tax on the $1,000 of services, the fair market value, but my basis now in those shares of stock is $1,000. Excuse me. There is no adjustment to outside basis over time unless additional shares are purchased or sold, or they sell their shares. So like with the partnership, there was this adjustment based on how much income the partnership was receiving. It was, you know, if we had any losses, then our outside basis would be adjusted downward. If we had any income, it would be adjusted upward. If we received a distribution, it would be adjusted downward. And we've got this constant flow of the basis with partnerships. With corporations, we don't have that with the outside basis. If I buy more shares, then that's gonna affect my basis. If I sell my shares, that's gonna affect my basis, but that's pretty much it. S corporations are different though. Like I said, they're kind of a hybrid, so they've got those basis, that fluctuating basis issue that partnerships have. Okay. Let's see. Let's look at Arturo here. So he contributed land with a fair market value of $100,000, basis of $40,000, in exchange for 90% of the stock. His basis in the stock is going to be $40,000, right? That basis just transfers over. If he happens to sell that stock for $100,000, he's going to recognize a $60,000 gain at that point. So that just transfers over. Questions? Are you tired of hearing the word basis?